No surprises, no news. A few new words. In a unanimous decision, the Fed retains its 5.25% to 5.5% target range for its benchmark borrowing rate and retains its language about determining the extent of additional policy firming that may be appropriate. The policymakers' assessment of the economy contains some new adjectives, but no new information. Activity expanded at a strong pace in the third quarter instead of solid. Job gains have moderated instead of slowed. Inflation remains elevated. The statement says tighter financial and credit conditions for households and businesses are likely to weigh on economic activity. That adds the word financial to the sentence, and it may be a nod to the idea expressed by many Fed officials that raising market rates are doing some of the Fed's work for it, a reason not to have raised rates today. This is the second meeting in a row that the Fed has held rates unchanged, and although the dot plot suggests one more move by the end of the year, the markets may interpret today's decision as confirming that rates have peaked. That's going to be a key question for Chairman Jay Powell coming up.
You see, Mike McKee, we want to get to you quickly here, but we see the market moving, lifting up, equities lifting up higher right now, with the Dow up 80 points, 0.2%. NASDAQ 100 on a tear, up 0.8% as well. The 10-year yield comes in ever lower. Bond prices up, yields down on the 10-year yield, 4.79%, distant from the 5% yield. Mike, the statement is here, and maybe it's a preparation for December 15th, but it seems to be a preparation for a presumed slower American economy. Into this press conference, do you assume we go from 4.x% Q3 down to something dramatically weaker in this present quarter?
I don't think the Fed is going to put it that way. They took recession out of their forecast a meeting or two ago and basically have said that the economy can grow at a reasonable rate without going into recession. Now, Jay Powell has suggested we still need a period of below-trend growth. We're nowhere near that now. If we do see it slow down, the question is, does it go too far, too fast? Right now, all indications are it wouldn't, that we could see slower growth without seeing recession, and we could see inflation continue to come down. But that's a question for them. Are they in damage control right now, making sure that they don't go too far because they think the economy is going to slow, or do they think they've done enough at this point?